Oil's march higher continues, now up 3% this week, which would be its best week since mid-August. Brent up above $115 a barrel, but can it stay there? I'm Jamie McGeever, and this is today's Market Pulse. Well, I'm joined now in the studio by Chris Johnson. He's Reuters Energy Communities Editor. Chris, good to see you again. Brent is up about 30% since late June. That's obviously well in bull market territory and quite remarkable.
It's quite remarkable. This week, oil has been going up at a time when stock markets have been falling. Brent is up, as you say, about 3%, and stock markets, Dow Jones down 2%, FTSE down approaching about 2% as well. It's quite a divergence, and it's very surprising.
So it's not just a question of risk on trade, because if that was the case, then obviously stocks would be up as well. So what's happening this week?
Yes, I think if the oil market were looking at the fundamentals, they'd be looking at Spanish downgrades and they'd be saying, you know, now's the time to sell. But that's clearly not what's happening. The oil market is concentrating on Middle East supply risks. It's worried about the border tension between Turkey and Syria. It's worried about the tension between Iran and Israel. Obviously, 2 days ago, we had announcement of an early Israeli general election. That is bound to increase the rhetoric, the hostile rhetoric on both sides. And I think the market is clearly concerned that there's a possibility of some disruption to supply.
I suppose the question there, though, is the market right to be concerned about those supply risks?
Well, it's right to be concerned. Whether it's perhaps overstating those risks, I think is worth considering. The Turkish-Syrian dispute is certainly potentially dangerous, but there's no evidence at the moment that Damascus wants to take on Turkey at a time it's trying to fight a domestic civil war. Also, the risk to the Iraqi pipeline, for example, which carries a lot of oil from northern Iraq through to the Mediterranean, runs, yes, close to Syria, but it runs through Turkey. And there's no evidence whatsoever that that is really at risk. And also, are we closer to war in the Middle East at the moment? Well, we might be, I suppose, but there's no evidence at the moment, for example, that Iran could close the Strait of Hormuz for any length of time. Most of the Iranian oil is not going west anyway. There's much reduced exports that's going east. So yes, I think the risks are overstated.
So I suppose that begs the question again, which we'll all be asking, is why are we up at $115 a barrel?
And that's a good question, and we don't know exactly, but I think we can surmise that there's a possibility that quantitative easing and the inflow of assets, of money into the asset markets as a result of what's happening in the United States is beginning to have an effect. We know that in QE1 and QE2 it pushed up asset prices and oil in particular very, very dramatically. And I think it's reasonable to assume that by now there's some sort of osmosis happening. How far this is going to happen, I don't know, but I think it's reasonable to assume that it's going to be underpinning prices at the moment. The money's looking for a home, and oil looks like a pretty good place to put it.
On the other hand, though, obviously we've had the IMF downgrade world growth forecast, and just yesterday we had OPEC and the EIA actually downgrading their outlook for demand growth in oil. Surely the demand factors must be taken into account as well.
Absolutely, but there's a lot of evidence to show that the oil market at the moment is not really looking at the fundamentals. Both OPEC and the US government, as you say, has cut its estimate for oil demand growth. That's certainly a negative factor. But in the face of what the market considers a possible loss of supply from the Middle East, if that's true, then I think it really does fall into some sort of insignificance.
OK, Chris, thank you very much. I'm sure we'll have you on again soon to talk about this very subject. Thank you. That was Reuters' Chris Johnson. But before we go, just a quick look at Spain's 10-year yield after S&P cut the country's credit rating to near junk last night. A test of the 6% level early in early trading this morning. But perhaps that was a half-hearted attempt, and we've now eased back to around 5.85%. And with the euro back above 129, you might ask, downgrade? What downgrade? That's all today, but do join us every day at this time at 1200 BST for a look at what's moving on financial markets and why. I'm Jamie McGeever. This is Reuters.